Since August 2012, the Bank Secrecy Act and anti-money laundering rules require mortgage professionals to report suspicious activity on suspicious activity reports, or SARs. Each mortgage company should have at least one individual registered with the Financial Crimes Enforcement Network, or FinCEN, as a supervisory user with the ability to file SARs. Suspicious activity must be reported within 30 days of its occurrence. All supporting documentation must be maintained for 5 years in a secure location and must not be shared with others without FinCEN's permission. The requirement for filing SARs also includes the creation of a BSA AML compliance program, including internal controls to ensure compliance, independent testing, a designated AML CO, and training for appropriate personnel. The training should be ongoing and include updates on developments and changes to BSA and related regulations. This training also must be documented, and it must include the date of occurrence and all attendance records. If internal policies are changed, companies should notify their employees. Prior to engaging in any activity which may involve money laundering, companies should collect the following customer information: a name, an address, an identification number such as Social Security, and a government-issued form of ID with a photograph, such as a driver's license. Your institution may refuse to complete any transaction in the event that a customer can or will not provide any of this information and cannot prove his or her identity to the satisfaction of the AML-CO. SAR Basics. When a member of the company detects any red flag, he or she should investigate further under the direction of the AML-CO. This may include gathering additional information internally or from third-party sources, contacting the government, stopping the transaction, or filing a SAR. A SAR should be filed for any activity involving $5,000 or more of cash or assets where the company knows or suspects 1. The transaction involves funds derived from illegal activity. 2. The transaction is designed to evade any requirements of the BSA regulations. 3. The transaction has no apparent lawful purpose or is not the sort that the customer would typically engage in. Or 4. The transaction involves the use of the company to facilitate criminal activity. This $5,000 threshold can be met by combining multiple transactions together. It also varies depending on the type of abuse suspected. As a reminder, the AML-CO should retain copies of any SAR filed with all supporting documentation for 5 years from the date of initial filing. Companies should make such information available to FinCEN, any appropriate law enforcement agencies, or federal or state regulators upon request. When a SAR is filed, companies should not notify any person involved in the transaction that was reported, except as permitted by the BSA regulations. This information may only be requested by FinCEN or other appropriate law enforcement or regulatory agencies. Any requests to access this information by other parties must be reported to FinCEN.